In a complete corporate liquidation, the IRS taxes the same event at two levels. First, the corporation is treated like it sold its assets for fair market value. Second, the shareholder treats what they receive as payment for their stock. On the EA exam, they love questions that mix these two computations together, so always ask, what happens to the corporation and what happens to the shareholder? Start with the shareholder side. In a complete liquidation, the distribution is treated as full payment in exchange for the stock, so the shareholder generally has capital gain or capital loss. Amount realized is the FMV of cash and property received, then subtract the shareholder's stock basis. That's it. No E&P dividend layering like a normal distribution. Liquidation is stock sale treatment. Now the corporate side. In a complete liquidation, the corporation recognizes gain or loss as if it sold each distributed asset at FMV. Gain or loss equals FMV minus adjusted basis. This is a big contrast to non-liquidating property distributions, where C-Corp recognize gain on appreciated property, but generally can't recognize a loss on depreciated property distributed. Here's the classic trap. Property distributions outside liquidation. If a C corporation distributes property with FMV below basis in a non-liquidating distribution, the corporation cannot recognize the loss. The shareholder's distribution amount is still the property's FMV, and that FMV becomes the shareholder's basis in the property. On the exam, watch for non-liquidating versus complete liquidation. Liquidations also have reporting and final filing requirements. The corporation must file Form 966 within 30 days after adopting the resolution or plan to dissolve or liquidate stock. And the corporation still files a final income tax return for the year it goes out of business, even with no activity. If it ends on a day other than the last day of its normal tax year, you have a short year. For that short year final return, the due date is the 15th day of the 4th month after the short tax year closes. That's the same pattern as a regular corporate return, just anchored to the short year end date. EA exam tip. If they give you a dissolution date like January 10th, count forward to the short year end, then apply the 15th day of the 4th month rule. Harborview Financial Group is a cash-basis C corporation. It distributes property to a shareholder in a non-liquidating distribution. The property has a fair market value of $120,000 and a basis of $72,000. How much gain or loss does Harborview recognize on the distribution? The choices include 0, a $48,000 gain, a $48,000 loss, or a $72,000 gain. Think about it. The answer is a $48,000 gain. In a non-liquidating distribution, a C corporation recognizes gain on appreciated property as if it sold the property for FMV. So $120,000 minus $72,000 equals $48,000 gain. The tempting wrong answer is 0 because people confuse this with no gain on distributions, but that's not how C Corp property distributions work. When you start with taxable income to compute a C corporation's earnings and profits, which transaction decreases E and P? Options include the dividends received deduction, long-term contracts on the completed contract method, mine exploration and development costs deducted currently, or corporate dividends and other distributions to shareholders. Think about it. The correct answer is corporate dividends and other distributions to shareholders. Distributions reduce earnings and profits when taxable income is your starting point. A tempting wrong answer is the dividends received deduction because it reduces taxable income, but E and P is adjusted back toward economic ability to pay dividends. Distributions are the direct reduction.